Good morning, guys, and welcome to the Camp Financial Stock Market Update. So, um, obviously, yesterday, we'll go to the markets as a whole. The Dow at one time actually was up to 19,950 and then settled back in to close at 19,911, another new high, or at least a closing high. NASDAQ closed at 5463. Which I believe is also the high for the NASDAQ. I don't remember back to the 2000 time frame, but I do know the S&P closed yesterday at 2271 is also an all-time high. So markets again were strong yesterday. We're looking this morning. I looked at the futures and basically it's looking like it's probably going to open pretty much flat. We're going to be maybe up. We're going to be up a little in the Nasdaq and the S&P were both up a little. The Dow was indicating a little bit down to flat at the open. So some of the big news yesterday that I saw, looks like oil starting to sell back off a little bit today as supplies start to ramp up. Some of the generic drug makers performed really well yesterday. The diversified utilities were strong. Independent oil and gas was strong. But the biggest sector that really did well yesterday is actually the tech sector. So Apple had a pretty solid day yesterday. Facebook was up 2%, Google up about 1%, or Alphabet as it is now. Microsoft up 1.3%. The semiconductor stocks did real well. Avago, Intel up 2.3%, IBM up 1.7%. Pretty much all of your, what you would consider your tech giants had really strong days yesterday. The financials basically flat, not a lot of movement there. Obviously, most of them have moved 20 to 30% already in the last month, since the election. So not a lot of real room for them to move right now until we catch up on some earnings and find out, whether or not it makes sense to have these stocks continue to expand their price to earnings multiple. So that's kind of the market as a whole yesterday. Let me get back to the other page on my screen here. I'm trying to see if there was anything else. There's been a lot of upgrades and downgrades recently, which is interesting. Not a lot of big companies that we need to be specifically concerned about their earnings, but a lot of news necessarily, but a lot of them have been moving. One, for example, that I have in my stock portfolio that I'll be losing from the portfolio on Friday because I'm not going to pay to buy the option back, and that's SeaWorld. So I had sold. I think I've pretty much explained the whole trade on here, but basically back in August I sold a $14 put option on SeaWorld. So basically what that is if the stock drops below $14 at option expiration, it'll be exercised and you'll own the stock at $14 a share minus the amount of money that you got paid for the option. So I got into SeaWorld at $13.60 a share. Right after I got the shares, I started looking, and I decided that I would sell a call option at $16. So if So this is the opposite of the put option, right? So if the stock goes above 16 bucks a share, uh, then it would be exercised. Um, my thought process was, with where it was at the price at that time, I think it was just right around 13 bucks. Um, I was really just looking at selling the covered call, which is an additional way to get some yield from a stock. But it paid me a dividend in October, as well as the money that I collected for selling the call option. Now the stock's at $19.50 a share, and this Friday is expiration date on that option. So on Friday, I'll be liquidated from the position on SeaWorld. Total trade on it's going to still be about a 35% gain. If I had bought in, at the 1360 where it was exercised and was continuing to hold, obviously we'd be up 40 some percent. We're going to be up about 30% out of the position, and take the cash and the profits and put it back on the sidelines and until we find the next trade that we want to make. So that kind of just to kind of give some color around that. Like I said, SeaWorld's one. So they got big news yesterday. That's where I was going at with that. So they're working on a new amusement park in Abu Dhabi, and so with that and an upgrade, the stocks run up, another about a dollar and a half in the last week. So let's take a look. I apologize for the yawn. Let's take a look back here real quick. I actually want to look at my investing system that I've been using for, so I made my first trade with it in October of 2010. Made two more in March 25th, 2011. Another one November 3rd, 2011. The fifth one on January 13th, 2012. And slowly I've been making more and more trades in this system as we accumulate more money in our account. It makes it easier to find other opportunities. So to give you an idea, so I'm not going to bore you with all the details of the deep, all the way to the point details, but essentially what I do is I'll take, for me, I'm taking $1,000. I'll buy $1,000 worth of whatever stock it might be. Once it is up, so it costs me 10 bucks a trade. So once it is up, the $10 plus the $20 so for when I sell as well. So once it's up $20 plus 10% of my original investment, I sell, and but I only sell the initial position. So I leave my gain in the system just to let it keep going. And with that as well, I always reinvest the dividends. Every stock in this system is a dividend paying stock, or at least was a dividend paying stock when I purchased, so that way it compound, as we talked about on Monday's show, it's compound interest on the dividend. So it just keeps compounding and compounding. So let's take a look at so the first stock that I did this with was Kansas City Life Insurance, and they actually did essentially it was a stock buyback last year, where they went in, and if you didn't own at least, I think it was 35 shares, I don't remember the number, but if you didn't own at least a certain number of shares, they went in and bought your position out from you, and took those back, and then did like a kind of a reverse split. Basically, they were trying to shrink the number of investors in the company. So, it is what it is. They bought it at a fair price. It was above what the stock was trading at that time. So, we still came out ahead, and that's fine. So that was the first one that we did that with. So let's take a look at the second stock that I did that with. So the second stock I did that with was Kimberly-Clark, and my original investment was $972.60. Like I said, and that was bought on March 25th, 2011. Then by the end of October, that had hit the 10% gain, and so that left me with $161 invested in Kimberly-Clark. Again, and that was October of 2011. And I've just let the dividends keep growing, keep going. Every time I get a new dividend, it just reinvests, as well as obviously the stock appreciation since then. And now, right now, I have $313 invested in Kimberly-Clark, so just less than 3 shares. But that shows you, and it's been almost a 5-year time span, and we've doubled our money in Kimberly-Clark, really by nothing other than just reinvesting the dividend. And again, the price accumulation. So then the next stock we did that with was Chevron. We bought in 2011. Chevron took quite a bit of time before it finally made it above that 10% threshold. That was September of 2012 actually. And there again, so when I sold, I was left with $162.20 in Chevron, and right now it's at $192.67. So that's it's about a 20% gain. It's not a lot, but again, compounding of the dividend. It's not even 2 shares of Chevron, so it's no surprise that it's taken a lot longer for that to ramp up. Let's look at the next one. So the next one was AVA, and blank. I know it's a water. I'm pretty sure it's a water utility. Avista Corp. That's what it is. Let me pull it up here. Yeah. So Avista Corp. Primarily a water utility stock. Again, bought $999 worth. Let it run. Sold the original investment. Kept the profits of $117 in there. That was June of 2012. And today it's at $222. So again, we've essentially doubled in the 4 years since, 4.5 years since. And then the fifth and final one we'll talk about today is Eli Lilly, the drug manufacturer. Our original investment, $995, took that back off the table. That was January of 2012. Took that back off the table and left the profits there in July of 2012, $101. And as of today, that is at $181. So at one point in time, actually, it was up. I think it was up to about 220, 216 over the summer this year. Sold off a little bit, but again, the reinvesting of the dividend. Every time that dividend hits, we put more, just a small fractional share back into the stock, and that's how I'm using this system to slowly grow wealth over time by reinvesting the dividends, and slowly building, picking, and then once I sell the original investment of one stock, I take that into a new stock, reinvest it. And so also, not only is this slowly building wealth, but it's also giving us a very diversified portfolio by, every time that we go back and buy, we look for certain traits of a company. And there's only been one stock that we've actually purchased twice. Everything else has been brand new companies. So I hope that helps kind of give some color around dividend investing and the importance of allowing your dividends to continue to grow. If you have any questions, feel free to send me an email. You can message me on Facebook, Twitter, either one. So I appreciate it. Take care, and we will see you next time.